Hello and welcome to the YSL Legal Learning Table series. Today I have the pleasure of introducing Jarvis Archer, Managing Director and Restructuring Practitioner at Business Reset. Jarvis Archer is a registered liquidator and chartered accountant with over 20 years of experience in business turnaround, distressed debts, and corporate insolvency. Jarvis is known for his practical, results-focused approach. He specialises in helping small to medium-sized businesses navigate financial stress. Jarvis works closely with accountants, lawyers, and company directors to deliver clear strategic solutions across restructuring and insolvency matter. It is my great pleasure to welcome Jarvis here today, and thank you very much for your time, and I look forward to learning lots more from you. Thank you, Jarvis. Over to
Great.
you.
Thanks, Karen. Okay. So business liquidity and restructuring, a deep dive into staying solvent for you and your clients. Hopefully that's not something for any of the watchers to worry about, just for their clients. So what are we covering here? So how to keep your clients solvent, why profit doesn't equal cash, where cash gets tied up, when insolvency becomes a risk, what restructuring options exist, and how small business restructures can help. Now, sorry, Karen, I'm sorry to do this. I'm just quickly going to shift my screen. Is that looking okay for you? Okay. Hopefully that screen sharing still looks fine. Sorry, I just had to move it there because of the positioning. Now, let's rip in. So the first thing there, profit doesn't equal cash. And it's a bit of a trap because you raise invoices, you've got sales, that all flows through, the profit and loss looks good. We're making money, but then we look at the bank account and where's the money gone? And so why that is because accruals accounting is where you're putting those invoices that you either receive from a supplier or that you issue to a customer in your accounts. And so the numbers are there in your profit and loss, but when you look at your balance sheet, actually it's going to show up as a balance owed to you or a balance you owe to them. And that's where the difference comes in, that if it's cash, well, you only put them in when you get paid. So, I mean, in your BAS, often people will account on accruals because we raise invoices, but don't necessarily get paid at the time. But then in your BAS, you only report your GST for the customers you've been paid for or for the supplier invoices you've paid out. And that's where people can get lost with these little things that aren't quite clear from the financials if you don't know your way around them. Now, that means that if you're not tracking your cash flow and if there's problems through your process, that can cause you to get into tight cash flow situations or get caught out where you might need to pay wages, but actually you don't have the money to do it, even though on paper you should. And so I guess it's key there is that profit doesn't necessarily mean solvent. I'll go through that definition of insolvency shortly. So just quickly speaking, this is a methodology I use. Where's the money gone, right? And so I kind of call it the 6 buckets method. Now, it's essentially all on the balance sheet, makes it easy to look at. And the thing is, there's heaps of lines, stuff everywhere when you look at accounts and nothing's together. So really grouping it into those big areas helps quickly diagnose what an issue is. And so first off, let's take out the recoverable assets, so the cash and the fresh debtors. There's no point looking at that, but it's good to know, okay, well, we've got some money over there. Now, trading losses, that's a big one. That's where the money's, we've lost the money in the way that we've run our projects. Unrecoverable assets, where something called director loans, I'll cover off today. Sometimes people use their company to do a property development. They invest in a new venture or buy a business, and the goodwill is sitting there on the company's accounts. The problem is, while it might say $300,000 on the balance sheet, it's not actually worth that. And so those things we need to go, okay, well, take them out of the picture because sure, we spent 300 grand to buy this business, but we couldn't sell that now potentially. Then it gets tied up in working capital. And this is another common one I'll cover today. So aged debtors, work in progress, and for businesses that buy and sell stuff in their stock. And then probably less common is either businesses go and buy equipment with the cash in the bank rather than getting finance, or they go and expand. They set up a new premises, they fit out a premises, or they might lend it to someone or lend it to another company of theirs, right? because they have a taste of profit, good year of trading. It's all optimistic. Let's go and like open up 2 or 3 of these premises, and then it can all get tight. And that costs cash. And again, if they don't finance it, well, then it's pulling the cash out of the business. And that's probably the ATO's money if they can't pay the ATO. So they're funding these things with the ATO's money. And then the other thing is there where they're paying down other debts first. So they might get a loan to buy a franchise or a business. They might put the money in themselves at the startup, but then they pay that money back to themselves. Now that's fine, except that if they're not making enough profit to pay down that debt, again, they're using money in the business that's actually to pay the ATO or other things to pay down that loan. And so it's causing difficulties that are showing up elsewhere in the business. So then looking more closely at the debtors, the unpaid invoices, looking at the work in progress, and then the director loans. I'll cover some examples here so that people can see those things in the financials and pick up when that might be an issue. And it is relevant for law firms who I understand are most of the viewers today, because as professional services firms, WIP is a big thing. We charge time, we do work. Unless you're getting paid at the beginning of the job, then you're going to have work that you've done that you haven't billed. And most of us probably don't get caught up trying to account for WIP because of the pain of trying to look at timesheets and work out how much will we recover. Ain't nobody got time for that. So often it gets missed. And, I guess that's fine if everything's going well. But when times get tough and you're trying to find out where the money is, why can't we pay our debts? We're working hard, we're busy. And that's where it's important to have a look at the WIP. And then with director loans, where that happens is where you're not on the payroll. So people become a business owner and they go, great, I've got all these tax breaks now. I'm going to go on drawings, save so much money at the end of the year. What they don't realize is that you need to make enough profit to cover those drawings at the end of the year and for it not to become a problem. And if you're not making enough profit, you actually end up paying yourself again with the ATO's money. So the poor old ATOs paying for a lot of things in these businesses in trouble, and they're the last to get paid, and that can be okay, but we want to avoid that getting to such a bad situation that we're facing insolvency. Now, I'll look at director loans first, right? They're the big one, and I don't really like them. The ATO definitely hates them, and accountants are a mixed bag. Some are fine with them because it lets you control when you pay the tax at some future point. On the other hand, some accountants know that their clients are going to get used to living on more money, and they don't put the money aside in future when they're going to have to repay the loan or take less. So it just comes down to your situation, how sophisticated you are with running your business, how profitable your business is, and how much money you need to live on. So drawings, director loans, they're not actually an entitlement to your company's money. You're only entitled to be paid a wage, or you can be paid a dividend, or you can charge management fees and then you wear all the tax personally. So most people go to the wage and the dividend. Now the dividend's fine. You make profit. Say you take 75 grand. You through the year, at the end of the year, you made 100 grand profit. You pay 25 grand to the ATO for the company's tax, and your 75 grand just gets backed out because you've taken that through the year. You've got things to pay. You can't wait until the end of the year to see how much you're getting paid. Fine, that's how it works in theory. But what happens in practice is you need 150 grand to live on. Your company made 50 grand profit. So at the end of the year, we go, well, hold on a minute. There's only 50 grand or 75% to cover that as a dividend. And then there's 100 grand hole. And that's usually matched up to an ATO debt of 100 grand, right? And so these things aren't too hard to see if you know what you're looking for. So there's profit there if you're on the drawings. But because you're taking it out as a loan, it's on the balance sheet, there's the cash isn't always there. And that can be confusing, particularly for business owners who don't know their numbers really well. So directors end up paying themselves with the ATO's money, and it's a common reason why the ATO debt builds up. We often see an ATO loan and a director loan for about the same amount, and even the ATO knows that, right? So it's because people, if they do look at the numbers and they say, oh, we're breaking even, we're making profit, they're not then accounting for the fact that they need to pay themselves as well. And if that's taken as drawings. Well, it's not in the profit and loss. It's over on the balance sheet, but who looks there? So they just look at profit. We're doing good. Fine. I could keep paying myself. The ATO hates them. It's the number one reason that they reject SBR proposals. And it's because they say we missed out 2 times. One, we missed out on the BAS money. Fine. You had a tough time. You couldn't pay your BAS. But we also missed out on the income tax because you paid yourself with our BAS money and you did that tax free. So for the other people out there paying the right amount of tax, doing the right thing, it'd be unfair for us to support your business where not only did you not pay us the BAS, but you also didn't pay us your income tax. And they're tightening up and tightening up. And that, for me, the best thing I can hear from a new inquiry is the director saying, I'm on the payroll. Fantastic. It means there's going to be a lot less issues. So that's the best practice in my view. So I'm going to run through some examples here just to demonstrate. So this one, stuff everywhere, usual situation with a balance sheet, ATO debts in a whole bunch of different accounts and loans and who knows what. So what I do there is I group them into buckets, either by coloring them or putting them next to each other. So what I can see here is, well, this company has got a few ATO accounts unpaid, 150, maybe 180. And then in the pink, they're making profits. So you go, okay, well, you made sort of 136 grand profit 113 grand profit this year in the current year earnings. And you've made 250 grand, 249 grand over the life of this business. So you should have heaps of money. What's the problem? And then we look at the blue line and go, oh, it's a negative liability. So again, you need to know that a negative liability means that's asset. So that actually says 543 grand. So the director's taken 543,000, but they've only made 250,000. So where'd that extra money come from? Well, if we look at this is the ATO payments over time and the ATO debts. And if we look across to the right 2 columns, it has the net change and the running balance. And what we can see is in FY21, we owed the ATO about 40 grand. And each year that's gone up 15, 20, 30 grand, right? And that's because we're taking the drawings and we're taking the ATO's money because we're not actually making enough profit to pay ourselves each year. So then what I do is I go, okay, well, let's pull those out of the balance sheet. I'll just create some very basic Excel cells down below that says equal the ATO debt row and copy that across just to bring these numbers down so I can just see them. So if I look at the ATO debt over time, we've got that 173 and that drops down. And then I do a little movement to see what's the difference between each year, how much has it gone up? And then I do that for the profit total as well. And then I do it for the director loan to see, okay, well, what's happened over time here? Now, as we look at it today, all we care about is the absolute totals. We don't care about the movement between the years. And so if you look at the absolute totals, the ATO debt, 173 grand, the profit, I mean, there's 250 grand. Where did it go? So they total up to 423 between them, just down in that total missing money cell. And then we go, okay, well, where'd 423 grand go, right? Because we need to pay the ATO. We can't pay them. That's why they've come to me to speak to Liquidator. And we go, oh, well, there's 520 grand in the loan. So the problem for the director is they go, well, that's just my wages, right? But they don't understand how drawings work. And so many directors seemingly only have it explained to them, or at least in a way that they comprehend when they're talking to the liquidator, which is a little bit too late because that's 4 years after this company should have really known about it, gone, oh, actually, let's go onto the payroll, or I need to be more profitable so I can take more money. Unfortunately, the same thing happens and happens and happens. And we can't pay the ATO and that debt's 170 grand and there's 520 grand of director loan. Now, down below where directors go, well, that's my wages, it's unfair if I pay it back. We'll go, okay, well, what would have happened if you had been on the payroll, right? Because the ATO, they say, well, fine, we get it, but pay your tax, pay your super, just like anyone else. And if you're not, then you're kind of hiding that tax from us. That's the thing, right? This guy with his 520 grand loan, that's probably like 300 grand of income tax that he should have paid, but he hasn't, right? So he hasn't paid 170 grand of BAS debt and he hasn't paid 200 to 300 grand worth of income tax. So it's a pretty big debt there, which he's not going to be able to pay back. And the ATO feels like, well, we're kind of being ripped off a bit. And so it's a difficult situation for me trying to say, let's save this company, and how do we bring the parties together when this situation has grown over 4 years? So what I do then is I go, okay, well, how much drawings did he take each year above the profit? And so in total, it's 270,655. So that's the total of the loan less the total of the profit this company ever made. So last year, so the blue cell, that's the one that we really look at, where we go, okay, well, hold on a minute. The movement here, the loan grew by 220 grand last year, which was FY24. And so he took out 215,476 up in the loan movement, but the company lost 5 grand. So the company lost money, but the director's not on the payroll. So he just said, oh, well, I need to, whatever, I got living expenses, and took 215 grand. So we can see how there's a problem there. The company lost 5 grand. So I mean, well, actually, he should have put 5 grand in for the company to break even, but he's taken 215 out. And where does that come from? Comes from the ATO's money. And that's why he's in touch this year. So then if we show, well, what's the real situation here? Well, the director's taken somewhere around about 120 grand a year of wages. So let's say they did that and they're in the payroll. So then that would accumulate to about 600 grand of wages over 5 years, but the company's only made 249 grand of profit. And that's where I go, okay, well, if you were on the payroll, you would have seen back in year one that you lost 83 grand, and in year two that you lost 169, and lost 85. And this adds up and adds up. And actually, we haven't made 250 grand of profit after paying the director. We've lost 323 grand. And this is probably the big issue I have with the loans, is that, fine, he owes the company 520 grand, not great, but something could have been done about it if they could see 5 years ago that, hold on a minute, my business needs to make more money, or something needs to change so that I can afford to pay myself the wage I need to live on. No argument at all that directors are entitled to a market wage, but pay it as wages then, or fix your company so that it can afford to pay you that, or you got to get a job working for someone if you need that wage to live on, and you can't run a business in a way that it can pay you that. So that's the complexity of director loans. The easiest thing is payroll, and you don't even have to worry about any of this. It's not going to be an issue. It's just the profitability there of the business that we can easily see and hopefully take steps to fix. This is a little ChatGPT thing, because every director says, oh, I should be on 150, 200 grand. I'm running this great business that's making no money. And, that's fine. I guess what ChatGPT says is, well, look, this is the sort of average wages is somewhere between, I don't know, call it around 80 grand if you're running a business making a couple hundred grand a year, up to maybe 200 grand if your business is doing 2 to 3 million, right? So I think probably somewhere in the 80 to 150 range is going to be, reasonable. And I guess my view is here, so summing this up, is if you see that director loan balance growing, and I appreciate for lawyers, you're probably only going to see this at the end. It's not something you're going to see early on. It's just when you're trying to work out what's gone wrong. If you see that there's no dividends, they're not paying out the profits, the director's not on wages, and then it's hiding that true profitability. You can see, is this business making profit or not? Then I guess for me, and this is something for the accountants and something you can talk to a company accountant about, because I always have to go back to the accountants and go, hey, all I see is the problem, but the accountant and the bookkeeper, the people who know how to fix it and the tax impact, maybe separate out, give them a fair market wage, a minimum, and then whatever they take on top of that, that's perhaps excessive, well, do that if there is profit. I guess that's the key then. And then it's clear they know what extra they can take if they need to. So that is the simplest way, in my view, to solve what is the biggest cause of financial difficulty. Now, let's move on to working capital, tied up in the business. So as I mentioned, it's in the receivables. It's where an invoice gets issued, it doesn't get paid. Inventory, I won't really talk about that. Don't see it as often with small businesses. And then uninvoiced WIP, right? So you've done the work, but for whatever reason, it hasn't converted to an invoice. It might be that you're working on a client file and you only bill at the end of the matter. I mean, it's a big one with personal injuries law firms, right? Where they do all the work and hope to get paid a big payout at the end. And it's risky because through those 2 or 3 years of negotiation, they need to have the cash to pay the wages, et cetera, to get there. And if they don't have that cash flow through that time, well, the business falls over and they end up getting sold, or someone else picks up that legal file. And the other thing is if a business doesn't have a great process for invoicing. So sometimes particularly in the construction industry, they do the work, great, and then they don't invoice it for 2, 3 weeks or something like that because who wants to do paperwork? Totally get it, but we've got to convert the work into dollars, and the only way to do that is through the invoicing. So a couple of quick examples here. So this is a company I look at recently. They have a bunch of debts, and when I look at the age receivables, I can see, well, hold on a minute, why have you got 80 grand? That's more than 3 months old. Are they paying you? Have they paid and just not been reconciled? There's a problem there. And that's something to look at. So it's a big one there because it might have been that they were doing work for someone and they went bust, or there was a dispute or something, they didn't pay them. And naturally, when that gets written off, well, it comes off the sales as well, and that can impact the profit. So it's where money often gets tied up, and invoicing is always so problematic. Now, do another one, and this one's very relevant for lawyers because this is actually a law firm's P&L. So this firm got a director penalty notice for a little bit of ATO debt, had a few issues there, partnership split, staffing issues, etc. And so looking at this, the yellow cell in the bottom corner shows, well, in the last 12 months, they've lost 220 grand. So for me, they're going, okay, well, you've got a director penalty notice. We've only got 21 days to get you into a small business restructure. I think it was about 5 days by the time we spoke to them. How are we going to make your business from losing 220 grand a year to be able to be profitable and show the ATO that, yes, this is a viable business that should be saved? Because the ATO doesn't want to save businesses that are just going to rack up more ATO debt that they're not going to pay. And so the accountant said to me, well, there's no WIP accounted for. So what they did is put the WIP in, right? Now, usually you'd only be accounting in the profit and loss, which we're looking at. You'd only be accounting for the movement each month. So if you had like 100 grand of WIP that you usually carried, well, it would just be the ups and downs that should come into the P&L. But I guess because there's no WIP anywhere on this one, they added the WIP in over a number of months. Not ideal. Be nice to account for it as we go. At the same time, I don't count for WIP. And like I said, most professional firms I expect don't count for WIP because of the hassle of measuring your ups and downs of your work in progress and recoverability each month. So fine, but this just highlights, even if you don't account for it, when you're trying to look for problems in a business, well, what's the WIP? Do you have WIP? Because for a construction business, for professional services firms, like there could be hundreds of thousands, even millions tied up in the WIP, and converting that into sales, into invoices means, oh, actually, the business doesn't look as bad as it did on paper because there's all this money that should come in. And then I guess the question is, well, will we get paid that money, etc.? Can we convert it to cash? So that's the sort of director loans, the working capital tied up in the debtors and in the work in progress. So now I get back to, from those little examples, I get back to a bit of the theory. So fine, you've got some problems there. Maybe you delve into the numbers to try and help your client to work out, well, what is your problem? Is it that you're losing money? Is it that you're taking too much of your money as a director? Or is it that your money's just getting tied up in your business? And then we go, okay, well, what are we going to do about this? And I guess from a legal standpoint, that's what you're concerned about is, well, what are the legal ramifications? So your company's insolvent if it can't pay its debts as and when they fall due, right? Section 95 of the Corporations Act. And people complicate it, and legal cases have the 14 indicators of insolvency and this and that. But the easiest way to go is, well, are you paying your ATO debt? Because you either can't pay or you won't pay. Now, won't pay means you've got some dispute, but maybe you're a sovereign citizen and you don't think you should pay tax in Australia, fine. But otherwise, most people, it's going to be because they can't pay. And if you can't pay, well, you're insolvent. Now, the technicality is there, well, if you renegotiate your terms of the debt to a payment arrangement with the ATO that you can afford to pay, then you can, and as long as you can comply with that payment arrangement, then fine, you've restored solvency as long as you keep paying that. What often happens is people default again and again, which is signs that, well, okay, yeah, we definitely can't meet our debts as and when they fall due. And it's an indicator that we're insolvent. And I like to keep it simple because it's already complex for people. They've probably had a good business. They've never had financial difficulty before. So they're already confused. Why make it harder than it needs to be? And I guess the thing is, people are more likely to not accept the facts and the situation than they are to go, oh, yep, put my hands up, my business is in trouble. People will more often just indefinitely trade on into the future until the ATO taps them on the shoulder and says, no, we're not watching our debt continue to skyrocket. we're giving you a director penalty notice, or we're going to garnish your bank account, or we're going to report your debt to a credit bureau, or we're just going to issue a statutory demand and wind this company up because we don't think it should be around anymore. So it's good if directors can make their own decision to deal with these things, at least proactively. It's always going to be later than it should be, but at least if they do it before the ATO forces it on them, it's going to be better outcome. And the directors have those legal duties around duties to not trade while insolvent. Their duties go from the shareholders instead to the company and to the creditors, right? Because the shareholders are all out of the money now if the company's insolvent because it can't even take its debts in full. So there's various things there, and naturally directors will want to protect themselves. But the best thing to do is, look, let's try and save this. Let's not have a liquidator in the place. Let's look at a restructure. Let's try and learn the lesson and learn about loans and get on the payroll, whatever, and hopefully keep trading forward and not have to not worry about all those legal obligations. And so small business restructure is the best option. It's been around since 2021. I love them, done the most in Australia. Fantastic. I'll cover them more today. Voluntary administration, been around forever. Someone like me comes in, I'm personally liable for every expense there. So I've got to run a really tight ship. It might cost 50, 100, 250 grand to do an administration, particularly with your trading and running a business. Business probably can't afford it. Everyone knows that the administrator's there, going to be very disruptive, unless your business is really so big that it's the only option. You're a national retail chain, you're an Arium, you're a Virgin, then it's going to have a big hit on your business, and the SBR will be a preferable option. Now, liquidation, it's like bankruptcy for a company. Close it down, sell the assets, investigate the affairs, report to creditors and ASIC, and then if there's legal recovery claims, then it might be that those get pursued. On the other hand, for most small businesses, the directors probably don't have too much, and the claims aren't so big that they're worth pursuing. So it just gets shut down and the company's deregistered by ASIC. So it's all about the outcome that the business owner wants to get, and I guess the risks and issues there. So just covering off on the small business restructure. So why would you do one? The easiest way to go to tell someone is, hey, do you want to or do you need to reduce your ATO and other debts you can't pay by 70%? And it's pretty easy to go, okay, debt amount by 0.7, that's how much you can reduce your debt by, right? It's a pretty big amount. Like people tell us it's life-changing, have grown men in tears. It is a fantastic option. And then the remaining 30% can be paid over up to 24 months, right? And I mean, it can make 100 grand debt, you could turn into 30 grand and then go, okay, well, you can pay that off at 1,200 a month. So you turn 100 grand debt into 1,200 a month over 2 years. Like, phenomenal what that does to both the balance sheet, to the debt, and then also to the cash flow, where paying off 100 grand a month over 2 years would be like 4 grand a month. So you're paying about a quarter. And the beauty of that is if they do a payment plan, it's interest free and they can pay it out early at any time, right? Fantastic. Because interest on the ATO debt is going to keep accruing at like 11, 12%, whatever. Now, the big difference between this and administration is the director stays in control the full time, right? It's a bit different to administration where everyone needs to know administrator's here and nothing happens unless I say so. But with an SBR, I'll just let the ATO know if they're the only creditor or the creditor's included in the SBR that, hey, there's an SBR, you can't take action against the company, we're going to reduce your debt over time, and we'll put the proposal to you shortly, right? And so I'm not writing to anyone else, really. Employees don't need to be notified, clients don't need to be, suppliers don't need to be. So it's much less disruptive. And as a result, it's much cheaper. It's a fixed fee for that restructuring period, which lasts about 9 weeks. And then it's just a percentage of the payments through the plan when the plan's accepted, and over that 1 week to 2 years that an SBR payment plan generally runs. A lot of liquidators don't like that. They don't like fixed fees. We like to say, hey, it's going to be cheap. And then lo and behold, it turns out it costs a lot more. But it's good for the business. It's good for your clients. It's good for the ATO because they're getting back 25, 30 cents in the dollar compared to zero in most company insolvencies. Now, it's not all unicorns and rainbows. It is a formal insolvency appointment. So it means it's going to be an external administration with ASIC for the 9 weeks of the SBR. and those documents we lodge for the restructuring will be on that ASIC record for the company forever. So someone could come along and download them if they wanted to. And then it's on the company credit file. It will show as external administration. Now, unlike the ASIC record, which flicks back to registered after the 9 weeks and the plan's accepted, the company credit file will have that external administration for the whole period of the payment plan. So if it's 2 years, they're not going to have a credit score for 2 years. They're just going to have a big red flag on their credit file. So that might be a motivator to go, well, hold on a minute. Let's just pay this out early on acceptance. We'll find the money, make it happen, because we don't want our credit file to be in tatters. When that happens, we help out. We make sure that their credit file gets updated, and what do we do? We make sure the credit file is updated to try and get them back to normal as soon as possible. Important one there, I haven't noted it, but for Queensland, it doesn't impact the QBCC license, because the QBCC Act was written before the SBR came in, and the way the QBCC Act is written, it specifies the types of insolvency that trigger an exclusion event. SBR wasn't around, so it's not included. So it is a loophole, but QBCC is very proactive. They're happy with these. They get it. And why wouldn't they be? Because mostly they're writing off federal ATO debt, which is saving all that hurt and pain and money at a state level, where home warranty insurance, angry subbies, angry homeowners. So it avoids all that. So fantastic for that. A little bit tougher in New South Wales and Victoria, where they lose their insurance and have to reapply for it once the whole SBR payment plan's done. Doesn't affect their licenses. And important to know, it's often a question there that's saying, okay, well, are we changing the company? But it's just restructuring the debts. And the aim is just reducing the liabilities down to the 30% of whatever they are at the start of the SBR. And hopefully that's it. We just want to cause as little disruption as possible to give that business the best chance of success. Now, eligibility criteria. So you've got to jump through a few hoops. So it's for small businesses. So that's less than $1 million in unsecured debts. So car finance, any all-PAP secured finance, they're out. Technically, you could calculate the shortfall. Some people do, some don't. Usually I've found that finance is, if you tell them there's a shortfall, they'll say, no, there isn't. And that's it, right? So I'll invite them in to say, hey, do you have a claim? But usually they'll ignore it. Now, banks are very good around these. They understand that actually this will probably help them in the long run, help them have a better chance of getting paid. And they know they're usually not getting paid if we're going into liquidation. It's got to be a company. It's not for sole traders, partnerships, personal trustees. So a company, a corporate trustee, that's fine. For individuals, individual trustees, you're looking at personal insolvency options. There is an equivalent to this called a debt agreement for debts up to 140 grand. If you go beyond that, debt level goes beyond that, you're looking at a personal insolvency agreement, which is more like a voluntary administration, and you can't be a director under a PIA, whereas you can be under a debt agreement. So this system's based on the debt agreement system, really. Now, you need to have your ATO lodgements up to date, and you need to have your employee super paid in full. I've got that note slightly wrong there, my apologies. So the super guarantee charge for directors can actually be included in the SBR. The first 2 grand of their super would need to be paid during the SBR, but then anything else can be included. So they've just got to pay the staff super. So the success factors, right? So it's all fine. You're eligible, going to jump through the hoops. And then, are you actually going to get your SBR approved? Is this a viable business? Have you been a good taxpayer? That's what is going to matter to the ATO. And why the ATO's opinion matters so much is that an SBR is approved if the majority of creditors vote in favour. So usually the ATO is the biggest debt. They're the majority, if not the only debt. So if they say yes, we're going through, and anyone else is just getting rolled in. Now, we look at the ATO lodgement and payment history over the last 2 years, because if you haven't been paying the ATO, they're going to think, well, you either can't pay or you won't pay. Neither of those are going to be in your favour, whether you're going for a payment arrangement or for a small business restructure or some sort of deal, right? So if I look at it, I get the ATO portal off the accountant. I go, well, hold on a minute, you haven't paid for 6 months. Start payments now. That's the key thing. It's all well and good that you lodged everything, but COVID's over. That's the ATO's view. So we're returning to normal. We're trying to get our $45 billion small business debt book down. You got to pay us if you want to stay in the game. Direct loan accounts, we talked about them. I've talked about why the ATO has an issue with them. They feel like it's unfair. It's the number one reason that they knock back small business restructures. If a business is trading, it doesn't have to be trading. It can just be a shutdown, alternative to liquidation. And that's better for the ATO or creditors, because if there is any money left, well, they're getting a slice of it. If you're a QBCC license holder and you shut down your company, well, doing an SBR means you're not going to bin your license there for 3 years. And then the business, so if it is trading, it's got to be profitable. It's got to be viable. As much as the ATO, sure, they want some money. They're more concerned about their future debt, because that's what they can control is, do you get a second shot? Are you going to pay your debt in future? Not just, the SBR and the old debt, but also, is the new debt going to get paid, or is it just going to get up and up? Because that's what they don't want. And that's what they're controlled by, going, no, SBR is not going through. And the proposal must be realistic, and it's got to be achievable. If they're paying installments, we've got to give a cash flow. If they're paying a lump sum, then we've got to have a bank statement showing, yep, they've got the money. It could come out of the sale of a property or refinance of a property. And there it's just looking at, well, is there a pre-approval? So SBRs in practice. So I've done I must have signed up about 250 of these, and 230 have been approved, probably close to 240. And then there'd be like 20 or 30 that are in the process waiting to get voted through or getting reports done up. So the ATO, they saw, like in 23, I think we started the year on a 30 or 40 a month. And I was doing, I don't know, 10, 15%. I was doing about eight a month. And then by the end of 23, people went, oh, actually, this isn't too bad. So there was 80 a month. And that quickly jumped to about 350 is how many the ATO looked at last month. So a lot of people haven't heard of them. Their accountants haven't told them about it. They didn't know it existed until they know someone that went through it. And it is a strange thing. It's such a good thing there. It's changing lives. And so many business owners who have got ATO debt, it doubled from 17 billion to 30, I think I said 35 billion after COVID, right? So that's a lot of small businesses carrying a lot of debt. On average, it's about 400 grand that we see. And they're finding out about it. Every time I open Instagram, I'm getting like 2 new businesses, accountants, nobodies, marketing agencies saying they do debt reduction, 80% off. And so there's a lot of people getting into this, a lot of cowboys. You can go straight to the insolvency practitioner and they don't charge you anything to get the SBR started. On the other hand, you could go to a pre-insolvency advisor who might charge you 10 grand or more to get it set up, which is not necessary. There is work here, and there is help to prepare people. And so there is work for lawyers if they want to help someone understand their options and the rules and look at their business, because there are some things like related credit loans. If you don't want them to prove in the SBR, well, they just get wiped by the process. So you might look at, is there security required around those loans? Is it reasonable to secure them so that might have a chance of preserving them if an SBR happens down the line? If people are putting money into the company to fund an SBR, well, they should definitely secure their money with a loan agreement and a PPSR registration, because if the company goes into liquidation later, well, they don't want to have just thrown hundreds of thousands of dollars down the drain. And so a 350 a month is what the ATO sees. It's 1 in 5 insolvencies, 20%. And the ATO a couple of years ago said they were approving about 91%. Now, I reckon that's probably gone down a bit, but what's happened is, hand in hand with that, is where we was, 15%, 18% return to the ATO was like a cracking proposal in 2022. That base has gone from about 15 up to 25 or 30%. And we're often offering 50% return paid up front. So if you see some advertising saying, yeah, reduce your debt by 80% or more, 85, they probably, A, aren't really being honest, and B, might not actually know. They might not have the experience. They're just copying the other ads they saw to try and entice people in. The reality is, in our view, 30% after costs is what we usually see the debt reduced to. So it might be 25% the ATO, and then our plan fee will be 5%. So that's the 30%, and the 70% gets written off. Because what clients care about is, well, what's it going to cost me, right? How much is the upfront, and how much do I pay? Breaking it down in between, not so worried about. They're just like, is it $2,000 a month? Okay. Are there other hidden costs or anything? No, great. I can pay that, and that makes sense, and I can write off 70% of my debt. So our success rate, we have always focused on, we're selling an outcome here. It's not like insolvency usually where everyone just knows it's going to be bad news. This is someone's business, someone's life, someone's one shot at saving all of that. Because if they don't get it, well, liquidation is probably what they're looking at, right? And that's where all those legal recovery claims, all the other stuff comes in, potentially shutting down their business. So the way we do that is we really look at businesses closely up front. Before they pay us a cent, before we're signing them up for an SBR, we look at the ATO, we look at their zero accounts, we're assessing the director loans and the profitability and the ATO payment history to go, yep, you're a good candidate, or hold on a minute, there's a few sins here. We need to fix those up before we go ahead. Or look, this isn't going to work for you. Maybe you need to look at restructuring to a new company and just liquidating the company. The ATO is never going to say yes. So why pay us 10 to 15 grand just to come back to the same position where you're then going to have to go and find a liquidator and pay them again, right? I don't want to take someone's money if I can't offer them the outcome for an SBR, just selling something that I can't actually deliver. And there's plenty of people out there doing that, and they're getting their proposals rejected. But it's just the marketing, the lack of knowledge that people have. They don't really know who to go to. So all we can do is just keep that high success rate and try and get the word out. Now, there's critics, right? They say, oh, SBR just saves companies that should have gone into liquidation and failed. Now, I obviously don't agree with that. And I think people think it's unfair because they didn't get a 70% debt reduction. The thing is that usually people have gone through some COVID impact. Their business got shut down. They couldn't have staff. They had, isolation or social distancing, so their business couldn't actually trade profitably. Or there's been heaps of mental health and physical health things, divorce, people get sick. And so when you put in context, we'll go, well, okay, well, this guy actually had a heart attack, so he couldn't work in his business, or he had a cancer scare, or this lady had depression or something and couldn't work for like 6 months because of the stress or whatever. Do you want to go through that to get your 70% debt reduction? Probably not. And so those people that criticize it, I think generally it's coming from a sort of more of an emotional thing because there's no economic reason for it. The ATO is getting more money than they've ever got from insolvency. Suppliers are usually getting paid in full or most of the debt. Business is saved. Employee entitlements are done. Super is getting paid. All things that don't happen in another sort of insolvency. So, and it's not like these people could pay it in full. So what I see there is in the 230 successful ones we've got, less than 10 have not completed their plan and failed. And so like it's a 95% success rate. Now, if businesses fail within about 50% of businesses fail within the first 2 years, apparently. So that's pretty good going if most of the ones that are getting through are surviving, much more than most. So I'll quickly just close off on SBR and DPNs. So if a DPN is received, you got the 21-day debt and you got lockdown debt potentially if they've lodged any BAS late. So an SBR is one of the options to avoid personal liability for the director penalty notice. Now, I assume people know that a director penalty notice is a notice the ATO can issue for BAS debt and super, but mainly the BAS debt we're talking about. And it gives the director 21 days to do something, or they become personally liable for the company's BAS debt, which, it's a bad day when that happens for you. Can make you personally liable for 300 grand, $1 million worth of company debt, and that sinks your personal financial position pretty quickly. It doesn't do anything for a lockdown director penalty notice or an expired director penalty notice that they received months ago, unless there's payments, say before the SBR, they pay down the DPN debt and then they do the SBR when the DPN's reduced, or the payments through the SBR are applied to that. And there's not really any guarantee that SBR payments can reduce DPN debt because the DPN sits off in a separate account under the director's name and the BAS account for the company where the payments are made. They've got interest, penalties, non-DPN debt. It's a bit of a mixed bag. And so only some of that will flow through to the DPN. And then if the SBR doesn't succeed, then the ATO can't actually issue another DPN afterwards because they've done it. It got remitted by the SBR. So even if it fails, which isn't very often, but it at least clears that DPN and protects them from another one. I think we're pretty close to wrapping up. So if an SBR isn't an option or it fails, like I said, there's a few hoops to jump through. They might have 200 grand of super they just can't pay. Then maybe a voluntary administration is what they have to look at. It's not as nice, but it might be the only option on the table. They might go, well, look, let's just sell the business. We want out. We're exhausted. Fine. If they can find a buyer, go look for one. Often that'll be a competitor. They could do a restructure to a new company. It does bring with it the phoenixing risk, but there's legal phoenixing where you pay fair value, and there's illegal phoenixing where you don't, and then you liquidate the old company. There's a lot of it happening. It was particularly before the SBRs. That's really the only way that a small business could restructure and survive, because administration wouldn't be viable. It was too expensive for them. Just close the company, or just find the money, refinance the house, pay the debt, or pay it off over time. So that's it. That's me. There's my details. Connect on LinkedIn if you like. There's lots of short videos of me that will either make you hate LinkedIn and seeing me, or you might find something useful, hopefully.